Welcome to a quick video to review the growth planning system. The system has been developed over the last year or two, looking at simplifying the way that we show businesses what a forecast with significant increase year on year can do for top line revenue, while at the same time looking at what the impact is on product profitability and teachable, valuable, repeatable, the TVR framework on the products and services. So all in all, just a way to see at how small variances within the system can actually contribute to massive losses at the end of the year. Also, this is just to show how everything sits together. So how do we plan sales? How do we forecast our sales on specific products and services? How do we segment further out of the sales of our products and services? How do we look at the margins and the profitability? And then how do we look at the TVR framework overall? So I'm going to quickly run through a scenario that will illustrate how these elements fit together and also the impact that it has on year to year. So if we look at a standard forecast, now not many businesses have this forecast, so you can view this in a simple Excel spreadsheet where we look at what the previous year's sales figures were and then run a forecast for the next 5 years at 30%. Now you'll notice this links into what we normally set, even in the value builder scenario planning, but definitely in the business builder session where we're targeting 30% plus growth, depending on what that previous year's growth was. So in our case here, we want to grow the turnover from the previous year from 202 Rand to 262. That's a 30% growth. Then we forecast that growth, showing that it's a total of 1,900. This is a very effective exercise to do with business owners, as it's not always that they look at what the impact is of what they're doing and what they can achieve and what that looks like over 5 years. Normally, when this is actual revenue that has been captured within here, the impact on their revenue forecast is massive. At the same time, because we are driving a product and service focus level as well, we focus here on gross profit, not as much as net profit for this exercise. So the GP, the way that we forecast or we're running at the moment, is between 40 and 45% that we're forecasting that GP to increase. So going from 40% and a marginal increase all the way through to 45, giving us 837 Rand of GP on the 1,900 top line revenue. So if we take those numbers, then it's our starting point. We look at the next point. In order to achieve those sales, we need to figure out which products and services are contributing to those sales numbers. So it's important that this becomes a detailed exercise which illustrates both what the customer, the products, and what the current sales and compared to the forecasted sales for each is. Remember, we're trying to figure out how to get to 30% growth. So in this example here, we're looking at the forecasted, and we are actually plotting customers' product specific information. So on the first one, we can see that we've got customer A. Customer A, we are actually selling product A to, but at the same time, we can look at customer A and identify customer A as part of a specific segment. So if this was we're selling to one individual retailer, we can then identify retail as a whole. So if we were selling to Moses' Butchery, we can now advertise as the meat or butcher segmentation and then go for a broader segmentation of that customer. Customer A already proves that we can succeed in segment A. So there's additional sales that's already coming from the historical fact that we're dealing with customer A, which is in segment A, and out of that we can target an additional 10 Rand sales. That's 100% improvement since seeing we have not sold product A into segment A. So product A, customer, we can also approach the customer A and upsell to product B. So illustrating upsell. So we've actually achieved two elements now. We've looked at customer A, looked at the segment they are in, and actually targeted other customers within segment A with product A. We've also looked at why we're not selling product B to customer A. So targeting an additional R4, that's 100% improvement since seeing we have not sold B to A yet. Then we're looking at customer D. Customer D, we are selling currently product C to, why not upsell product F? So that illustrates the sales per customer. We've got customer A that buys product A, currently selling 40, we're increasing that forecast to 44. Customer B buying product A, we're increasing that forecast to 60. Customer C is currently buying around 60 Rand in average sales of product B, we're increasing a forecast of 66. The same for D and E. That is our strategy of selling more to existing customers. Then customer A and D both upsell, cross-sell, provides us an additional 24 Rand of revenue, and then driving a specific segment strategy provides us another 10. So if we can look at then our average sales target was 200, our forecast is 259.50, rounded up to say 60. That's on track with our 260 target there. So that will give us a 30% increase, which is in line with what we're targeting. So now we have our forecast and we've got our strategy of selling more, upsell, cross-sell, and segmentation, which should be worked out in lower level detail. This is just an example. Our next step then is to look at sales, taking those sales number, customer A, B, C, D, E, and plotting January to December, what the forecast and the actual sales are month on month. I've just shown a gap. I've just shown you going from January to December, the months in between on product level. And as you can see, against our forecast and actual, we are already running a gap. Now, normally this creeps up month on month as we're not meeting sales. The illustration here is to also show what that small variance will make on our bigger forecast at the end. So again, taking your product service strategy, sales strategy, breaking it down to a per month, per customer, per sales individual level will give you what the forecast should be and what the actual, and will illustrate if there's any variances at the moment. So again, January to December, and there are already variances creeping up from our actual as we capture those. If we look at product level, we should have product information that shows each product, what our direct costs are, and what our sales price are, so that we understand what is our product level margin. And as we can see here, product A already, we can see is running at a 30% margin, and product A is the biggest contributor of our sales. If we look at the number of sales that we are already, product A is the one that we're selling the most of. We can already see that product F has got a 50% GP, and that's only a brand new sales that was not part of our previous forecast or sales. So again, showing the importance of plotting the product level margins in order to drive not only profitability, but where our sales activity should be focused on. Now, if we go one step further and take that same product and that same margin, look at the sales contribution. The highest sales contribution, as I said, coming from product A, and the lowest from F, but they've got the highest margin. If we perform a teachable, valuable, and repeatable scoring on this using the TVR, you can see that the higher the score out of 10 is, the more teachable, the more valuable, and the more repeatable. We are again focusing on product A, and there's no repeat sales out of that. It's once-off sales. That means if we look at the highest scoring TVR, it's 18. That's our highest margin, highest teachable, valuable, repeatable scoring, and we are actually focusing on the wrong products. So if we take this element compared to where we were forecasting, we would then see that we're currently running at 40%. That means we've got a sales variance and we've got a margin variance. And this is due to us not effectively targeting and managing those sales on a month-to-month. The fact that we are targeting sales on the lowest TVR or margin-based products. And this combined will have an impact of 458 Rand on sales variance. That's a 24% sales variance. And 252 Rand, that's a 30% impact at the year end on what we're losing on GP. Once you take this linkage of sales to products, products to month by month, to margin, to TVR impact on actual customer numbers, the impact is massive. So again, the growth planning system, not only just showing us how these functions interrelate, but also showing the compound nature of the variances that creep in if we're not targeting the right products and we are not targeting the right products with the highest margin and the highest rating of success.